Welcome back. We are continuing with our section on candlestick types, and in this section we are going to be looking at bullish candlestick types. So we're going to briefly summarize bullish candlestick structure. Then we're going to look at the types of bullish candlesticks. So briefly, let's summarize the structure of the bullish candle. Bullish candlestick indicates market momentum is moving in an upward trend. An easy way to remember this is by picturing an actual bull. The bull horns go up just like the market will when you spot this type of candlestick. So what exactly are you looking for? Keep an eye out for those green colored candlesticks we were talking about earlier. Once you have a bullish candle, take a look at the body. The bigger the body, the stronger the upward momentum for that specific point in time. Ideally, you want to identify a full-bodied candlestick with small wicks or no wicks at all. So, a bullish candlestick is comprised of the open and the closing price. So these determine the bullish candle's body. So a bullish candle opens at a lower price and closes at a higher price. So we've got the opening price and the closing price. For example, say you're looking at a monthly chart for Euro USD. Then you find out that Euro USD opened at $10 and then it rallied all the way to $11. That's a indication of a bullish candle on a monthly chart or whichever time frame that you are looking at. Then we've got the body. This represents the price range between the open and the close of that time frame trading. Then we've got also the low, which represents the lowest price point reached during the time frame of the candle. Then we've got the high, which represents the highest price point reached during the time frame of that candle. Then we have got the upper wick and the lower wick. These represent the extended price action above and below the candle's body. The length of the wick indicates the high and the low price points for that time frame. So now let's look at the types of bullish candlesticks. In this section, we're going to focus on bullish candlesticks and patterns that you are most likely to find on the candlestick chart. There is a wide variety of bullish candlestick types and patterns. In this section, we're going to focus on the following types. We're going to look at the shooting star. We're going to look at the morning star. Then we're going to look at the bullish engulfing candle. Likewise, with the bearish engulfing candle, these are very strong reversal candlestick patterns. Then we're going to talk about the dark cloud cover. Then we have a tweezer bottom. And we're going to also look at the bullish pin bar and bullish harami. So firstly, let's take a look at the shooting star. A bullish shooting star is a two candlestick pattern that signals a warning of an impending bottom or low in the market structure. The shooting star tells us that the market opened near its high, then strongly dropped and finally reversed off to close near the opening, thereby showing us that the session's drop was not sustained. That's why you see on the illustration we've got a long wick here. meaning lower prices were not sustained. The bulls pushed price higher. During a downtrend, take note when price approaches a strong area of demand or support zone. When you see the illustrated candlestick pattern, buy in the direction of the trend at the opening of the next candle or when it fulfills the criteria of the bullish shooting star. You place your protective stop loss at least 15 pips below the lows as illustrated on the picture. Now let's look at a morning star. So you can probably call it just morning star, or if you want to be specific, you call it bullish morning star. In a downtrend, a strong bearish candle followed by a doji signals a bottom reversal. The doji spinning bottom type candle appears at a low or bottom in the market structure or a strong demand zone. This is a very strong bullish reversal pattern. So a morning star is also referred to as a doji spinning bottom type of candle. During a downtrend, take note when price approaches a strong area of demand or support zone. When you see the illustrated candlestick pattern, buy in the direction of the trend at the opening of the next candle or when it fulfills the criteria of the bullish morning star. You place your protective stop loss at least 15 pips below as illustrated. Take note, the close of the bullish candle must be beyond 60% upturn of the bearish down candle as illustrated. Now let's look at a bullish engulfing candle. The bullish engulfing pattern is a major reversal signal with two opposite color big-bodied candles comprising this pattern. The close of the bullish candle must be beyond 65% 10. What do I mean by 65% 10? As you can see on the illustration, the bullish candle, in this case represented by the green candle, the close of that bullish candle is beyond 65% up 10 from the bearish candle. Consider the following criteria to qualify a bearish engulfing pattern. The market structure has to be in a clearly defined downtrend at either demand zone or support zone. Price here has to be at least approaching a support zone or at a higher time frame demand zone. The second body of the pattern should be bullish candle with strong momentum to the upside, which is illustrated by this green candle here. Two candlesticks make up the pattern. The second real body must engulf the prior body. Wicks are not much of a priority to the engulf. The wicks don't really make much of a difference. That's retail traders funds which don't really move the market. We need to focus on the body. When you see the illustrated pattern, after the engulf bullish candle appears in the direction of the trend, buy at the opening of the next candle with a protective stop loss approximately 15 to 20 pips below the lows of the week. Now let's look at a bullish dark cloud cover. This is a very rare bullish pattern. It normally appears at a low depicted by the bullish candle body closing higher and closing with body at least 60% up previous bearish candle. This is a very strong reversal pattern comprised of two candlestick patterns that is formed at a low or demand zone after a downtrend or at the bottom of a consolidation zone at a demand zone. When you see the illustrated pattern, buy in the direction of the trend at the opening of the next candle or when it meets the criteria of the bullish dark cloud cover with a protective stop loss approximately 15 to 20 pips below the lows of the week. Take note, the close of the bullish candle must be beyond 60% up 10 of the last bearish candle in the pattern. Then we've got tweezer bottom. Tweezers are two or more candlestick patterns with matching highs or lows. During a bearish market, a tweezer is formed when the lows match one another. So when market is in a downtrend, approaching probably a demand or a support zone. Why I always emphasize demand or support zone? Why am I emphasizing that? Because that's where you expect market to reverse. When you see these type of patterns forming in a no man's land on your market structure, then there's no need to consider them, because if you consider the market can move either way. So if you do consider them at a strong area of demand or support, you tend to make a more decisive decision to your trading with better odds for the market to reverse. So when you see the illustrated pattern, after you have two candles that have met the criteria of a tweezer bottom, buy at the opening of the next candle with a protective stop loss approximately 15 to 20 pips below the lows of the week. Now let's look at a bullish pin bar. A bullish pin bar signals very strong rejection at a bottom or low of the market structure. It signals a very strong bullish signal on a break above. It's illustrated by buyers pushing the bears higher on a candle, forcing a large wick to the upside, as you can see here, and visually showing us traders rejection of lower prices. So you can see this last bearish candle, it was once a big bodied black candle to the downside. Say this is a 4-hourly chart. At one time during that H4 time frame, it was a big bodied bearish candle. But prior to that time frame closing, prior to the H4 closing price, the bulls pushed price all the way to the upside, thereby signifying to us that lower prices are being rejected. That's why you see here market open and then rally to the upside. When you see the illustrated pattern, buy at the opening of the next candle with a protective stop loss approximately 15 to 20 pips below the lows of the week. So you need to open your position at the opening of this candle with your stop loss 15 to 20 pips below the lows of the week. Now let's look at a bullish harami. The bullish harami pattern is a small real body which is contained within a prior relatively long bearish body. Like I said earlier on, harami is an old Japanese word for pregnant. The long bearish candle is the mother, and the small bullish candle is the baby. The bullish harami pattern is the opposite of a bullish engulfing pattern. It's not much of a strong reversal pattern, so you really need to be careful or to consider other aspects of your price action when you are using this pattern. A bullish harami appears at a low or a consolidation point in the market. A break above the inside bullish candle indicates a potential bullish move to the upside. When you see the illustrated pattern, buy at the opening of the next candle with a protective stop loss approximately 15 to 20 pips below the lows of the week. And to conclude this section, there are only two groups of traders. There are only two groups of people in the market. There's buyers and there's sellers. We want to find out which group is in control of price action. We use the candlesticks to define that who is in control. Wide range candles state that there is high volatility, and narrow range candles state that there is low volatility. Low volatility leads to high volatility, and high volatility leads to low volatility. So in order to keep your account safe, guys, during the period of high volatility, you should analyze candles themselves, be in a position to see what the market is trying to tell you when you read the candlesticks. When you read your market structure, be in a position to identify who is in control of the market. Are we at a higher time frame supply zone or at a higher time frame demand zone for you to consider reversals? So practice in hindsight. Look at the previous past price action. Try to identify these price patterns, these candlestick patterns, and then you see how the market reacted. So I'm going to see you again in the next section of the course. Thank you.